This is video 7, the final video in the personal finance investment portfolio project videos there. And for this particular video, we're going to be focusing on exclusively mutual funds. Now, we've already looked at mutual funds of bonds and briefly at mutual funds of stocks, but I just want to remind you that a mutual fund of stocks constitutes a basket of different stocks and many different investors investing in those same stocks, even the same amount of the stocks there. So all of these people might be holding a certain percentage of Walmart, a certain percentage of Chevron, depending upon how much money they've put into that specific individual mutual fund of those stocks. So I want to give you an example of a particular mutual fund. And this information comes from the Vanguard Dividend Growth Fund. And these 10 companies constitute the largest portion of that mutual fund. So I want to draw your attention to the specific industries of those funds. So you have United Health, you have Johnson & Johnson, you have Medtronic, okay? You have Merck. All 4 of those constitute companies within the healthcare sector. Others here are in the consumer defensive here, like Colgate-Palmolive. Others are in consumer cyclical, like Nike. And don't worry about understanding the specific terms there. But what I'm trying to draw your attention to is that, again, if you're going to diversify or try to spread out over many different kinds of industries or companies, this is a way to do that. But what I want you to also notice is that this mutual fund is a bit more concentrated in health. And the reason why is that they're focusing on dividend growth. And the people who invest in a dividend growth mutual fund are trying to get both the rise in price going up, like you saw with the Berkshire Hathaway stocks earlier, but they're also trying to get an increase in dividends or a consistent dividend there. So they're trying to get both price appreciation and a solid dividend. And the fund manager that manages this specific fund is trying to concentrate more towards the healthcare sector with that in mind. And make no mistake, if you're invested in a mutual fund like this, there is a mutual fund manager. There are always mutual fund managers, but these guys have a particular purpose in mind. And this is what's called active investing, but we'll get more to that in just a moment. Index funds are also a type of mutual fund, but recognize that rather than holding, say, a few dozen stocks like you might see in Vanguard's Dividend Growth Fund, this would constitute hundreds. So for instance, I mentioned earlier how a number of American investors are invested in the S&P 500 index. So recognize that if you're invested in that, you're invested in 500 different stocks there. There's an advantage in investing in index funds. One, they're low cost. It's literally a computer that's managing it. Yes, there's a mutual fund manager still, but it's basically hit go on the computer and it mirrors how the S&P 500 is doing. So if you're holding, like, say, a Fidelity S&P 500 mutual fund or a Vanguard one, it's designed to mirror how the S&P 500 is doing. So if the S&P 500 is up 2%, then your particular Fidelity S&P 500 fund will also be up 2%. And for that reason, it's low cost, okay? If you're invested in an active fund like Vanguard's Dividend Growth, your goal is to do better than the S&P 500. You want to actually increase above that specific level. If you're invested in an index fund, you're not so interested there. You don't want the super up because you know that if it goes beyond the market, it's going to go far below the market as well. So you're simply trying to go for where the market is, and that's the big advantage in index funds. Most top investors indicate that if you're not terribly comfortable with investing, index funds are the absolute best way to go. A big way that a lot of people are doing that is through something called an ETF. So there are mutual funds which are a basket of stocks. And ETFs are a basket of stocks or a basket of stocks as well. But what's different about an ETF relative to a mutual fund is that with an ETF, they can trade like a stock throughout the day. So a mutual fund, you can only buy and sell at the end of the particular day. So for instance, if at the end of the day, Tesla is trading at $817, the market is closed, that's what it's trading at. The Vanguard Dividend Growth Fund is closing at, let's say, $40 a share for that specific mutual fund. Then when you buy that mutual fund, you will buy it at exactly $40 a share. An ETF functions differently. If you put in an ETF order at say 10 p.m. or I'm sorry, 10 a.m. and the Vanguard Dividend Growth Fund has gone from $40 to $42, you can buy it at the $42, but that also means that you can buy it lower as well. And people who are invested in ETFs tend to try to do that. They're trying to buy at different points during the day to try to get a slight better value than you would with the mutual funds. But ETFs are largely just index funds. So I want to clarify that key point. So ETFs are not technically mutual funds, but they function the same way. They just allow you to trade during the day. At this point, I think it's really important to understand that there are two very different types of investors in the stock and bond markets. There are what are called active investors and passive investors. Now, when we're looking at index funds like the S&P 500 or something like it, recognize that we're looking at passive investing. And the whole reason why it's passive investing, folks, is that people who invest this way largely just put in, let's say, a few $100s from their paycheck every month. They don't care how the market is doing. They're just investing in the total stock market through something like the S&P 500 or Vanguard's total stock market that's 3,000 different stocks. And they're trying to simply match the market and how it's doing. But if I'm actively investing, I am trying to beat the market. So whether or not it's a bond fund where a mutual fund manager might be trying to get some low-grade bonds that can yield their customers higher gains, okay, there, or have the potential for that. As a passive bond investor, I don't care about that. I'm simply trying to match the market. So wherever the total bond market is, that's what I'm trying to do here. But over here, I'm trying to beat it. So recognize that there are mutual fund managers of both bonds and stocks that are paid good money to try to beat the market for you. And people are willing to sometimes pay for that. You have to decide whether or not you want the risks associated with trying to beat the market. Some have done exceptionally well, but as we'll learn here in a moment, the vast majority have not done nearly as well. So for instance, what this is telling you right here is that only 12% of large cap mutual fund managers manage to beat the market. So if I'm trying to beat the S&P 500 here, okay, over a 5-year period, my chances of beating it are only 12%. And as the time goes up, it's even less likely. I have an 8% chance of beating the S&P 500 or the Vanguard's total stock market if I'm a large cap mutual fund company than this. The point, a lot of passive investors here are concluding, I'm not going to try to beat the market. I'm just trying to be the market. So if the S&P 500 is up 2% that day, I'm happy. That's great that that mutual fund that you have, that active management fund that you have is up 8%, but I also know that you're just as likely to go down 10%, whereas my S&P 500 company might only go down 3%. So I've lost less. And that's a big reason why what you see over here is a lot more people heading into index funds now. So wherever you see this red associated here are the gains in index funds. And the blue represents people since 2007 all the way to 2017, the amount of people leaving those actively managed funds. And a big reason why, folks, is cost. And I'm going to explain on that right now. They don't want the risk associated with active managed funds, and they also don't want to pay the amount associated with it. So I'm going to give you an example here. This blue line here constitutes T. Rowe Price's Blue Chip Growth Fund. It's a great fund, and as far as mutual funds are concerned, it's not highly priced. They're not using what are called load or commissions. All that you're paying for is the price of the mutual fund itself. And most brokerages even allow you not to have to pay a commission when you're buying the mutual funds, even though it's a different company than yours. So a number of people look at T. Rowe Price's 5-year growth 5-year growth over this period of time, and they look at this tremendous growth of T. Rowe Price. This yellow line constitutes the S&P 500. So I'm buying T. Rowe Price's Blue Chip Growth Fund with the understanding that it's going to beat the market here. It's going to beat the S&P 500. And over this 5-year span, you can see that it did, which means that it beat the odds. It managed to be in that top 12% that we saw a moment ago. But, and this is a key thing here in mind, I can own this S&P 500 fund for an expense ratio of 0.04%, whereas this mutual fund is 0.77%, meaning I am paying 19 times more for the fund managers managing this T. Rowe Price mutual fund than I am this S&P 500 index fund. So let me clarify. Remember how I told you that there are mutual fund managers managing the specific fund? They're the ones to ensure that you have this percent of this company, this percent of that company, and if it's actively managed, they do a lot more trading to try and manage just that, to try to get those specific percentages there, and they get paid higher money in order to do that. And that's where your expense ratio comes into play. Whereas if you're invested in S&P 500, it's largely just a computer doing all the work, because all you're doing with an S&P 500 index fund is just matching that. You're not having to pay big money to some active fund manager to try to do that, and you're paying significantly less. So again, the key difference here, folks, is do you want that Gucci shirt, or are you perfectly content with that Target shirt that might fetch equally good looks and get you that job anyway? Okay. Another way to view expense ratio, guys, is you can see that right here in this particular table. This is from Vanguard, and these are what are called target retirement funds. And I'm going to go over that in just a moment. But the short of it is that it's a mutual fund that has both bonds and stocks internationally and domestically here, right? So it's a pretty broad fund. And it's the total fund of these, but I'll get more to that in a moment. So total stock, total bond markets of these, and it's 0.16%. So you pay slightly more than the S&P 500, but you get a larger portion of the global market on each of these, and you're not paying very much for it. But take a look at these index funds. These expense ratios are 2.45%. This one was 0.16% here for this total global market here. Now, a big reason why somebody's going to get this Murray Asset Emerging Blue Chip Growth is the understanding that they believe that they're going to have greater chances at beating the market than anybody else. So they're paying several times more to the mutual fund managers for managing this fund. But here's what it means to you over time. If you get a 10% gain, okay, no expense ratios involved. If you get a 10% gain over your investment of $10,000, at the end of that 20-year time, you'll have $67,000. But with that same $10,000 over this core period of time of 20 years, with a 0.5% expense ratio, you'll only make $61,000. Let's go up to that 2.45% that we paid for in this last one. So let's look at this 2.45%. If I would have invested $10,000 into this key fund, and with the same 10% growth over that 20-year span, I would be earning $14,000 less. I'm sorry, $21,000 less than I would if there was no expense ratio involved. The point that I want you to conclude here from this, guys, is that this is why people are going for more passive managed funds. If you're wanting to beat the market, recognize that you're going to pay higher and higher expense ratios. But if you're wanting to just be the market, okay, you can pay far less, even far less than 0.5%, which means that you'll be able to keep a lot more of what you originally invested. And this, folks, is yet again why you see a lot more people heading into index funds and out of actively managed mutual funds. Okay, so I want to make sure you're crystal clear on that. Now, let me specify the target date retirement funds, because this is a fund that I would advise for many of you to jump into. And a lot of them can be pretty basic, and as I showed you, really low expense at 0.16%. What the target date retirement funds, guys, is that when you start working at, say, 22 years old and you're planning on working for 40 years, recognize that the vast majority of your target retirement fund is in stocks. You can see that 85%, okay, is in US and international stocks here, whereas only 15% are bonds. Remember I told you it's important to have a balance of both stocks and bonds in your investment asset classes at any given time. But as you age, as you get closer and closer to retirement, so this is your retirement age, and recognize that your proportion of stocks, both internationally and nationally, are much smaller. and your amount of government or US bonds, okay, and international bonds has grown quite a bit. And then as you go further into retirement, you have higher and higher amounts of bonds. And the big reason why, guys, is that over here, it's okay if the stock market totally dumps and loses 40, 50% of its total value. You're okay because you don't need the money right now. Whereas when you're in retirement, you need that money, which means that you cannot take the same level of risks as you could when you were in your 20s and 30s. And that is why such a much higher portion is towards that. And you can see that the further away your retirement is, the heavier you're going to be in stocks. And that, folks, is a great way to get the diversification that you kind of see here. This chart might be a little overwhelming to you, but I want to point out ultimately the benefits of it. In 2018, the market took a dump at the end of the year. It really crashed. So the asset class with the highest gain over that period was actually cash, meaning that if you were in CDs and money market accounts and savings accounts, you had an average gain of 2%, okay? Whereas if I was invested in large cap companies like Netflix or Facebook, I actually lost 4.5%. Whereas the year before that, it was emerging markets, meaning China, India, markets like that grew exponentially in 2017. The year before that, it was small cap companies. Guys, small cap companies are those companies that you've likely never heard of. Okay, they don't earn anywhere near as much as like a Facebook or a Netflix or anything like that. But recognize in 2016, small companies ultimately represented the most. In 2015, it was REITs. REITs, guys, are just they're basically real estate mutual funds that instead of investing in your mutual corporation, you're investing solely in landlords, essentially, and the businesses that those landlords and those companies that manage real estate do. My point to you here is that it's extremely important to spread out your risk across multiple markets there. If you're invested in, say, a Fidelity Total Stock Market Fund or a Vanguard Total Stock Market Fund, you have all of these. And that's ultimately the advantage in having something like the Target Retirement Funds that allows you that kind of exposure. Finally, folks, I want to end our full discussion on personal finance and this investment portfolio on one particular thing. Okay, if I would have invested $100 in 1926, that just $100 would be worth $587,000 now. Now, most of us are going to invest far more than $100, and we're going to invest a lot more recently than 1926. But the point is that if $100 can gain that kind of money, so can you. But even if you don't like the risks that stocks pose, let's say you just decide, I'm just going to keep it in my checking account. That's where I feel safest, or savings account. Recognize that no matter what, that $100, you would have lost $1,300 due to inflation alone. Remember, inflation is 2% per year. So the $100 that you saved from last year is actually worth $98 now. So if you're not invested in savings accounts or certificates of deposit or mutual funds of bonds or mutual funds of stocks, okay, that are earning more than 2%, you're actually losing money anyway. So no matter what, folks, you are taking a risk with your money. The question is what sort of risk do you want? And what is it that you're trying to do with your money? What purpose do you have? What goals do you have? And I hope that these videos gave you a big chance about how to reflect on that, how to think about that, and to learn a little bit more about yourself. Thanks so much for your time and have a wonderful day. Bye-bye.